Everybody, one panelist is still missing, but she will join soon. So, good afternoon and welcome to the 5th biennial ECB conference on fiscal policy and EMU governance. This year's conference focuses on the macroeconomic effects of fiscal policies and their interaction with monetary policy as the economy emerges from the COVID-19 pandemic. Before pressing ahead, a few points of organization. The conference will be held entirely virtually over 2 days, this afternoon and tomorrow afternoon. Apart from the opening policy panel, the conference will feature a keynote lecture tomorrow by Riccardo Reis of the London School of Economics, chaired by my colleague Philip Lane. The conference will also include presentations and discussions of 4 thought-provoking academic papers. The policy panel and the keynote lecture will be live streams. The entire conference will also be recorded and subsequently made available online on the website of the European Central Bank. Without further ado, let me now open the policy panel on fiscal stabilization and sustainability in EMU, post-pandemic challenges and the role of NGEU, a burning issue. I'm very pleased and honored to welcome today 4 high-quality speakers. Paolo Gentiloni, European Commissioner for the Economy, Klaus Regling, Managing Director of the European Stability Mechanism, Olli Rehn, Governor of Suomen Pankki, Finland's central bank, and Hélène Rehn, Professor of Economics at the London Business School. Before turning to our distinguished panelists, let me say a few introductory words on the topic of today's panel. The COVID-19 pandemic hit the euro area and other advanced economies hard. In 2020, GDP in advanced economies declined by 4.5%. This was the sharpest drop in decades. In the euro area, the hit was even harder. GDP declined by 6.3% with heterogeneous effects across countries, reflecting differences in the severity of the health situation, sectoral specialization, and digital development. The shock threatened to reignite financial fragmentation and economic divergence. Through economic and financial interlinkages, this exposed the entire euro area to deflationary risks and a persistent loss of productive capacity. But macroeconomic policies responded with unprecedented measures. The ECB implemented the Pandemic Emergency Purchase Programme to counter the effect of the pandemic. The program was given adequate size and flexibility to provide a response commensurate with the magnitude of the shock and ensure its transmission throughout the euro area. This offered all actors in the economy very accommodative financial conditions. As a result, and with the triggering of the general escape clause of the Stability and Growth Pact, governments were in a position to provide extraordinary fiscal support, and they did. Fiscal actions to support healthcare systems, households, and firms have been sizable. When factoring in the effects of automatic stabilizers, fiscal policy support in 2020 amounted to about 7% of GDP. While this was below the effort in the US, which amounted to over 10% of GDP, liquidity support envelopes available to firms were larger in the euro area than in the United States. They amounted to 19% in the euro area compared to 5.7% of GDP in the United States. But the main novelty was the European fiscal response. Not only were safety nets strengthened with the ESM's pandemic crisis support, but the EU showed its determination to provide a common response to a common shock by resorting to joint borrowing. The EU instrument SURE provided 100 billion euros to protect jobs and incomes affected by the pandemic. And Next Generation EU committed 750 billion euros to support the recovery and resilience of member states, with a focus on modernizing their economies and fostering the green and digital transitions. These initiatives had an immediate positive confidence effect. the EU demonstrated that it could act quickly, forcefully, and together. The euro area economy rebounded strongly when the economy reopened. And public opinion has reacted very differently from the previous crisis. Trust in the European Union and the European Central Bank, as well as support for the euro, have increased over the course of the pandemic. And a majority of Europeans think NGEU will be effective in responding to the economic effects of the pandemic. But we are not there yet. First, the recovery is still incomplete. The inflationary spike stemming from global supply shocks and the resurgence in the pandemic are hitting the euro area at an early stage of its recovery. Not only are we still some distance from having returned the economy to its pre-pandemic trend, but services, activity, and investment remain well below their pre-pandemic levels. An important question for our panel today is how fiscal policy can best protect the recovery throughout the current bout of uncertainty, and how it can support supply, for instance, by stimulating the reallocation of capital and labor where there is higher demand. Second, the proof of the pudding is in the eating. The implementation of NGEU will be key. We now have, for the first time, all the ingredients: national ownership, positive incentives, a robust monitoring framework, and common priorities. Recovery and resilience plans contain over 800 reforms. Successful implementation could provide a strong impetus to economic potential, convergence, resilience, and also mutual trust. Third, we must reflect on the future of fiscal policy and governance beyond the exceptional circumstances of the pandemic. How can we make our fiscal rules more countercyclical? What is the future of European fiscal stabilization tools? How should we think about monetary fiscal interactions at different stages of the business cycle? Should we be concerned about risks of fiscal dominance? How should we think about and enhance debt sustainability in a world of higher debt but also lower interest payments as a share of GDP? These questions have started a lively debate in policy and academic circles. With this, let me turn to our panelists. I will give each of them a few minutes to express their initial views on the issues I have just outlined. Following this first round, I will ask a specific question to each of our panelists. After that, we will use the remaining time to address questions that registered invitees will post on the chat function. We will start with European Commissioner Paolo Gentiloni. Dear Paolo, the floor is yours for your initial remarks.
Well, thank you very much, Fabio, and good afternoon to everyone. Indeed, the European economy has rebounded from the pandemic recession and maybe faster than expected. So the GDP figures both in Q2 and Q3 confirm that over spring and the summer, the EU economy as a whole moved from recovery to expansion. Some member states already regained their pre-pandemic output level, and all member states are in the recovery and will reach their pre-pandemic level next year. According to our forecast that I presented a few weeks ago, the EU economy is set to grow by 5% this year, 4.3% next, and 2.5% in 2023. I think we should be clear that this was not a given. The strong rebound is a result of the policy response that we adopted at national and European levels, and the positive interplay between fiscal and monetary policy has been decisive. Looking ahead, we know that new headwinds to the economic outlook are there and mounting. Bottlenecks and disruption in supply chains, energy prices resulting in headline inflation significantly increasing. And since the forecast in the last, after 3 weeks, the number of COVID cases and hospitalization has been rising, and uncertainty on the evolution of the pandemic with its new variant Omicron is increasing. And so virus containment measures at national level are being reintroduced and should be adjusted as needed. However, we do not expect the economic impacts of these new restrictions to be comparable to those of the lockdowns of last year. We will have an impact, but not comparable because the economy is now more adapted to deal with the pandemic, and because we have vaccines, which is, of course, crucial. Anyway, continued support from governments and the EU remain essential, safeguarding economic growth and avoiding the consequences of premature withdrawal. It's also worth noting that the public investment to GDP ratio in 22 is projected to be higher than pre-crisis due to the combined effect of higher national financial investment and RRF grants. This contrasts with a 7-year declining trend that followed the financial crisis between 2010 and 2016. As I said many times, we cannot be happy with just a rebound of our economies. We must aim for growth that is both sustained and sustainable. And we need, for this, also the discussion on key fiscal policy challenges and the review of our rules. On this, let me conclude focusing on 3 points. First, investments. Public investment needs are large for 2 key reasons. First, we went into the crisis with an insufficient level of public investment, one of the legacies of the previous crisis, where public investment in the EU fell to around 0 in net terms, and in a situation of population aging and rapid green and digital transition, we cannot afford to see our capital stock dwindle over time. We, on the contrary, need to renew and upgrade it. Second, investment needs have become more pressing. We estimate that the additional private and public investment needs related only to the green and digital transition will be nearly 650 billion per year until 2030. And of course, not the main part, but part of this need to be public investment. RRF is providing support to investment, but this funding will end in 25-26. So meeting our climate and digital goals will require very large and sustained increase in nationally financed investments. And this is the first key question that we must consider in discussing our fiscal rules. Second, the debt. Reducing high debt was, of course, a challenge in the years preceding the pandemic, given the context of weak economic growth and very low inflation. Post-COVID, the level of debt is projected to peak at 100% in the euro area this year and only gradually decline to 97% in 23. Hence, another key issue we must collectively reflect upon is how our fiscal rules can ensure a gradual, credible, and growth-friendly reduction of the debt to GDP ratio. Third and last point, fiscal stabilization. As mentioned before, coordinated counter-cyclical fiscal policy has proved highly effective in cushioning the crisis. However, the ability to provide fiscal stimulus in bad times requires building fiscal buffers in good times. It also requires, in the longer term, a European fiscal stabilization tool, something that the European Commission has proposed also in the past. For now, the RRF is helpfully also serving a stabilization role. But stabilization is not in the DNA of the RRF. As you know, is an exceptional tool that will run out in 2026. So overall, it is clear that changes are needed. And let me take the opportunity to encourage you all to participate in the public debate and provide your contributions also via our online survey. Next year, the Commission will present its orientation on possible changes to the economic governance framework with the objective of achieving broad-based consensus on the way forward well in time for 2023. You know that the general escape clause is not there, will be not there in 23 as a rule. Okay, grazie. Thank you, Fabio.
Thank you very much, Paolo. Let me now turn to ESM Managing Director, Klaus Regling. Dear Klaus, the floor is yours for your introductory remarks.
Thank you very much, Fabio, and greetings from Luxembourg. I think this can be a really important conference because the questions that you raised in the beginning are indeed burning. And I think when I look at the program over the next 2 years, I think I have the expectation that we can all learn something during this conference. So I think you set the scene very well. You described what happened. We went through the worst economic crisis of our lifetime. The policy response was very convincing. It was also different than the policy response in the past, partly because we have learned, but partly also because it's a different type of crisis. 10, 12 years ago, the euro crisis was a kind of asymmetric crisis, and there were serious macroeconomic balances in a number of countries that had to be corrected, and that was painful but unavoidable. Now, since last year, we deal with a symmetric crisis with asymmetric consequences. And I share your assessment that the policy response was very good. It was fast, it was powerful, and it was well coordinated among European institutions and, importantly, between national governments and what the European institutions could do. And also it was very important that EU member states that were most affected by the pandemic receive more financial assistance than other countries. And I think that's very important for the good functioning of the monetary union, but also for the good functioning of the single market. So we had the right response. Of course, it comes with a cost. Debt, as you described, has been going up, or the debt ratio went up for 2 reasons. The numerator went up and the denominator declined last year. Now we are catching up on growth. And so the ratio went up, but that was unavoidable. It was the right response. But we have now to think about how to deal with that. And in that context, I think it's very good that the European Commission launched again the review of the economic governance framework. Even before the pandemic, we know that the old Stability and Growth Pact had become too complex. It relied on some variables that are very hard to estimate, and that's not good for credibility because many people need to understand what's going on. And also, I think it's becoming clearer that some elements of the SGP do not reflect today's changed macroeconomic circumstances. In particular, I am thinking here of the lower real equilibrium interest rate. So I believe a simplified and credible EU fiscal framework could be built around the 3% deficit limit, a higher limit for the debt to GDP target, and a combination of an expenditure and a primary balance rule. So that's just one contribution to the debate that Paolo is asking for. I know there are other proposals, like from the European Fiscal Board, and I think all that is very valuable. But let me say a few more words, because I have talked about a possible higher debt to GDP ratio. I think that would be justified because there is a higher debt carrying capacity of sovereigns today than in the past, than at the time when the Maastricht Treaty was negotiated, because the interest rate burden today is well below the levels of the 80s and 90s, and that's the result of the long-term secular decline in real equilibrium interest rates. And I think the economic research, and there's a lot of research on that, has identified very clearly the reasons for this long-term decline. It's a demographic change, it's a rising inequality in wealth, and also the lower productivity growth. And while we can all hope that we can do something on productivity growth with the right reforms, with Next Generation EU, I think the other two factors, demographic change and income and wealth inequality, will not reverse anytime soon. So I think the expectation that this lower real equilibrium interest rate will be there for a long time is very much supported by economic research. But even though at the moment we consider that all euro area member states have a debt level that is sustainable, I think it's still important that over time, those countries that have debt ratios clearly above the euro area average should reduce these over time. This is also important because all our countries will face additional fiscal burdens in the future. For instance, the cost related to climate change, but also additional spending on pensions and healthcare in the context of aging. Also, I think it's important that all countries need to create fiscal space to be prepared for the next crisis. We don't know when it will happen, but we know it will happen one day, and it will always come as a surprise. In principle, this secular decrease in interest rates means that now euro area countries do have this higher debt carrying capacity. So there is some time to bring debt ratios down. And I think this could be reflected in the reform of the Stability Pact, because if you apply the old pact strictly, it would mean that countries should, within 20 years, reduce their debt ratios to 60% of GDP. And I think that would be costly, economically costly, but also politically costly. Finally, and that's my last point in this introductory round, I think there's an additional argument to be considered when we think about the appropriate levels of public debt. I think for the good functioning of capital markets, a certain level of sovereign debt is necessary. Investors want to invest in sovereign debt also, not only in corporate bonds and private equity. And some of that sovereign debt has to be safe debt. So a certain volume of safe assets is also needed to absorb the savings seeking low risk. And I think this level of this volume of safe assets has gone up probably over the decades. I think that might be a good area for more research, but particular savers that have a high income, high wealth, do want to put a certain share of their savings into safe assets. Also, regulations require banks and insurance companies to invest in highly rated debt. And if there are not enough safe assets around in the market, because highly rated sovereigns want to reduce their debt, maybe to 60%, some want to be even lower, then the demand for safe assets can easily exceed the supply, and that would mean interest rates have to fall further. Let me end with that. Thank you.
Thank you very much, Klaus. Our next speaker is Governor Olli Rehn. Dear Olli, the floor is yours.
Thank you, Fabio. And I want to thank you for the invitation to the panel. And I very much agree with my fellow panelists that the policy response, both monetary and fiscal policy response to the COVID-19 crisis has indeed been convincing and forceful. And it is important that we have the right policy mix going forward as well. I will come back to that later on and also in the second part of this panel discussion. I very much welcome the Commission communication that relaunches the review of EU economic governance and the related public debate. Let me kick off on my behalf with 3 points. First, the Commission communication highlights quite rightly, to my mind, the role of a well-functioning macroeconomic imbalances procedure. Macroeconomic imbalances are typically the root cause of the problems with potential spillover effects. Clearly, what is needed for sound economic governance is a comprehensive approach that jointly considers the macroeconomic imbalances and fiscal policies. We have discussed the Commission communication in the Governing Council of the ECB, and we stress the importance of sustainable fiscal positions for price stability and sustainable growth in a smoothly functioning economic and monetary union. In addition, in line with the ECB's revised new monetary policy strategy, I find it very important to recall that the pronounced trend decline in the natural rate of interest or the equilibrium rate of real rate of interest does imply that the effective lower bound is more frequently constraining the conduct of monetary policy these days. The stabilizing role of fiscal policies is therefore more important in proximity to the effective lower bound in view of their increased joint effectiveness in those conditions. My second point is that related to the EU fiscal rules, even though the existing EU fiscal rules that were reformed 10 years ago, latest, have been criticized, and the criticism is to some extent certainly justified. Scrapping the rules altogether would be a mistake. In my view, the rules should be simplified and further developed in order to make them more meaningful and thus functional. From the standpoint of both central banks and especially of sound economics and political economy for that matter, the fiscal rules should support two things. First, debt sustainability, and second, macro stabilization, especially when the economy is at the effective lower bound and monetary policy is constrained. When the rules are discussed, there are often contradictory goals, at least at the surface. Some tend to underline the need to avoid excessive debt, while others tend to underline active fiscal policies, or need for active fiscal policies. However, these views may not actually be in contradiction with each other. Combining them meaningfully would require that the rules are redesigned so that they will better support counter-cyclical fiscal policies during cyclical upswings or booms. If governments reduce their debt loads in upswings, then sustainability will be improved and there is thus more room for fiscal support during downturns. My final point is, third point is that as the rules will be reformed, what should the reform look like? Klaus referred already to the model proposed recently by the European Fiscal Board. In my view, it provides a good starting point for the reform of Stability and Growth Pact. Contains three elements. Without going into detail on this, a country-specific debt target related to long-term economic growth, an expenditure rule, and a general exception clause. On the expenditure rule, it could be defined so that it effectively limits expenditures, especially during economic upswings, and thus it could be made genuinely counter-cyclical. There is plenty of empirical research and evidence, for instance, by the IMF, that these kind of expenditure rules have been successfully applied in many countries, including in several EU member states. I would also very much agree that fiscal policy should be and become more growth-friendly. Addressing the challenges of the green and digital transitions will require significant private and public investment. So if effectively implemented, the funds under the Next Generation EU will support member states in addressing this challenge and further demonstrate the potential of EU-wide action. I stop here. Thank you very much for your attention.
Thank you very much, Olli. We will now close this round of initial remarks with Professor Hélène Rehn. Dear Hélène, you have the floor.
Thank you very much, Fabio. So, like the other speakers, I also very much welcome this debate and discussion on the reform of the fiscal governance in the EU at this juncture. It is particularly important. So before I turn more specifically to the Stability and Growth Pact, which I would like to discuss, I just want to make a remark on the necessity of the central fiscal capacity that we have been building. I think the pandemic has made this abundantly clear when we are hit by large shocks. And also, and this is also something that Olli emphasized, when monetary policy is at the ELB, the central fiscal capacity is particularly useful. It's also extremely useful to support structural changes which are in front of us, the transition to the green economy, to net zero, but also digital infrastructure, also a point that have been made by my previous panelists. This very much strengthens the resilience of the EU. And I think the conditions for the Next Generation EU to become a more permanent feature should be first and foremost good governance. And in particular, special attention has to be given to corruption, and NGEU has to deliver identifiable results. It may take several years to evaluate those results, but I think it is important to do that carefully. There is a very good start in some countries, and the selling of the bonds was also a success. So far, I would say it's a very good start. Now, let me, if I may, share a few slides on the reform of the Stability and Growth Pact, and I would like to make a few points here. First of all, I think these two very large challenges that we are facing ought to inform how we think about fiscal governance. We are facing pandemics. We will likely face more of that. We are facing climate change. And what has been striking in the international policy response facing these two large issues has been, on the whole, the lack of provision of global public goods, even when the return to providing these goods would be very high and, frankly, would increase the sustainability of the public finances. So I will develop this theme. Because of this issue that we are facing, this lack of provision of global public goods, even when it would actually be a prudent thing to do, I would like here to make a proposal, which I will call a prudential fiscal governance framework. When we think about our current fiscal frameworks, they tend to assess debt sustainability by forecasting the debt to GDP path, future deficits, etc. However, the forecasts very often build on median scenarios, which very rarely take into account the likelihood and severity of expected future crises. So we don't have usually much estimation of future liabilities, which will result, we know that, from climate change when we assess fiscal sustainability. And because we ignore these future liabilities, the incentives to act now to decrease them are essentially non-existent, and we end up in a much worse fiscal situation later. To me, that really is similar to the situation we have been facing in the past with financial crises. The unwillingness to act before prudentially has led us in the past often to face very high cost financial crises. And how did we act upon that? How did we react to that? We tightened micro and macro prudential policies. That meant we decided to pay a small cost now in order to avoid large cost later. This is the prudential idea. And I think we should very much import that idea in fiscal governance. So let me give a concrete example, very much back of the envelope, the pandemics. We have had estimates by the IMF that vaccinating the world cost around 50 billion. We have also had estimates of the cost of pandemics borne by different economies, in particular advanced economies, depending on certain scenarios. And there's in particular a paper I'm citing here, but there are more on these topics. The costs are very large. And interestingly, even though they are quite well vaccinated, advanced economies still bear a lot of cost because of trade, because of supply chain, etc., because of interdependence. So these costs are large. If I take the example of France, a decrease of GDP of 6.1% translated into fiscal revenues, which were very large in 2020. And so here, if you do simple evaluations, if EU were to vaccinate the world, pay the 50 billion, France pay about 20% of that, then in almost all the scenarios put forward in that paper, for example, that would improve the fiscal sustainability of France. So here, it's just a relatively straightforward example. A prudent fiscal policy enacted by the European Union would offer special treatment for this type of investment by taking it out of the 3% limit, of course, and would fully recognize that by investing now a little bit, we would actually decrease massively future liabilities. That's just one concrete example. But this concrete example should also be thought through in the context of climate change. EU has committed to net zero in 2050. In France, there has been some evaluations of the amount of public investments needed between 2025 and 2050. We also have multiple evaluations of the social cost of carbon. So here, for example, the Commission Kine has evaluated the social cost of carbon of around 750 euros. The state very much covers the share of these costs. Going forward, it's going to be very expensive. And so we can also make here a similar calculation, making some assumption on how much a country captures of the benefits from reducing the global CO2 emissions, because obviously here there is a global accumulation of CO2 that affects everyone. So making some reasonable assumption, we can compute the net present value of the fiscal cost of investment needed, the present value of a reduction in fiscal liabilities. And when we do this type of computations, what I think we often find is that if a country does it alone, then that would deteriorate its fiscal accounts. But if EU did it together, already the computations are not that clear. It could be that in some cases we get some positive effect on the fiscal accounts. And what we can be sure of is that since the social cost of carbon tend to rise over time, definitely there will be a point where this computation will be positive for fiscal accounts. Of course, the more countries act together, the higher returns, the more global public good is provided, and also the more higher returns in terms of the fiscal accounts and fiscal sustainability. So again here, a prudent fiscal policy would take out this investment of the deficit limit and would indeed build in the fiscal governance framework this prudential approach. So I think we should really replace the Stability and Growth Pact by the Sustainability and Growth Pact, built on this idea of prudential fiscal governance, which is simply bringing forward the benefits of more ex-post resilience, and by doing so, actually increasing public debt sustainability. So we should replace the target of a 60% debt to GDP by a modified long horizon target of an inclusive debt to GDP, which would take into account the liabilities due to climate change and to pandemics. We would start with these two big areas because we can evaluate them, and that would be precise, relatively precise. We should take the relevant investments up to a ceiling out of the deficit rule, so that would be a kind of green golden rule. And I would just like to point out that this is actually a framework that is more rigorous than the Stability and Growth Pact, because in the Stability and Growth Pact, we leave out a lot of very important liabilities, the ones which will come from climate change and which are coming from will come from pandemics. So it is actually in the economic self-interest of EU countries to finance some global public goods, and by doing so, and by putting that in the governance framework, this would actually improve their public finances and the resilience of the EU. Let me stop here.
Thank you very much, Hélène, and thanks to all panelists for this first round. Let me now turn to each of you with more targeted questions. Let me start with you, Paolo. I would like to ask you two questions. First, what is your view on the appropriate trajectory for euro area fiscal policy in the coming 2 years, given the current economic outlook? Second, the European Commission has recently launched a consultation on the future of the EU economic governance. There seems to be broad agreement that the existing fiscal framework needs to be reformed to make it simpler and more countercyclical. In practice, what could be the main features of a reformed framework? I'm thinking, for instance, of the discussion on unobservable variables such as the output gap, new operational indicators such as an expenditure rule, and the future of the debt rule.
Well, thank you, Fabio, and I think very interesting points were made by you and by the panelists during this first round, also in these issue, especially the second part of your question. As far as the fiscal policy in the next year and in 2023, well, I think we have quite clear the framework of our fiscal policy for next year. We gave our opinion to the draft budget, national budget, and well, I have to say that almost all member states are having an expansionary and supportive policy in 2022. And rightly so, from our point of view. So what we encourage is for 2022 very clearly to keep a supportive fiscal stance. Of course, not the same kind of support that we had in 2020 and 2021, but making this support more selective, more targeted. The universal support was absolutely crucial in these first 2 years. If we just refer to what we were expecting from the crisis one year and a half ago, we were expecting a wave of bankruptcies and a wave of unemployment. And then if we look to bankruptcies, we have one of the lowest level in recent years because of public guarantees. And if we look to the labor market, we have a very challenging situation with mismatches in several sectors and countries. But overall, we don't have an increase of unemployment. So this universal reaction, strong reaction, was fully justified. Abandon the supportive fiscal stance in 22 would be a mistake. Of course, this support should be more moderate or more selective. You can use the word that you prefer. Second point, of course, it should be differentiated because different situations can come from the different speed of recovery, from different level of debt, and from situation of sectors. So first, supportive in a different way, more targeted. Second, differentiated. Third, as we say, agile, meaning that we have some idea of the headwinds, of the evolution of difficulties that we are seeing and risks that we are seeing to our forecast, but we should keep the agility to change our policies if major risk will emerge. Then now we are discussing the fiscal guidance for 2023. We will publish a communication giving these guidelines in the first quarter of next year. And of course, this will be largely also subjected of the evolution of the situation. But I think that in any case, 2023 will be an evolution of what I said until now. So keeping a supportive stance, but making it more and more targeted and selective. We need a balanced approach because, of course, we have to ensure debt sustainability, but we have to ensure durable growth. Can we have a growth-friendly debt reduction path, or this is an oxymoron that is impossible to define? And here we come to the second part of your question, which is on the possible review and outcome of the review. Well, at the moment we are in a very initial phase, and it would be, I think, a mistake from the Commission side to anticipate conclusions of a review that is ongoing and that will involve member states, stakeholders for the next month. Two only remarks from my side. First, political remark. We need to work to find a consensus, of course. Is this impossible because of consolidated different interests, different views? Well, my opinion is that the past period showed that we can bridge these differences, can find compromises and common and shared solution. And I think there is a goodwill to do so among member states. Second, the state of play that I see is a broad consensus on the identification of the issues, the problems to face, which is already something. Not yet, and it would be in any case be too soon, a consensus on how to find solution, how to address these issues. But a certain number of issues, Klaus and Olli were mentioning them, are shared. We all share, I think, the awareness of the fact that in this global environment, we need a more realistic path of reduction of the debt. Second, this path could be not only more realistic, but also more differentiated. And this differentiation could encourage ownership by member states, having their own target. Of course, if you have this differentiation, you need also at the same time simplification and enforceability, because this is the possible deal. No? We have differentiated target, we have a pace of reduction more realistic and growth friendly. At the same time, when we establish this path, we need to comply and to have tools to enforce. The last two issues that I see shared is one, the need to simplify, to be careful with non-observable features, and to give some attention to the expenditure rule as a possible alternative. And final point, but of course one of the main one, is what Hélène was very well stressing in her prudent naming of prudential framework, the need to face the challenges that we have. Because if we continually speak of these challenges, of the pandemics, of the green transition, of the post-COVID era, and then we don't consider this in our rules, I think we will be not doing our duty. So these are the main issues that I see in this debate, but Fabio, we are really beginning this debate.
Very interesting. Thank you, Paolo. I will now turn to Klaus. Dear Klaus, fiscal instruments at European level have seen important changes recently. Shortly after the ESM treaty has been revised, NGEU has brought about a new paradigm. Against this background, how do you see the role of the ESM in the post-pandemic era? Would you see benefits in bringing the ESM within the EU legal framework?
Yes, thank you, Fabio. Difficult questions. We have not yet, we are not at the end of the revision of the ESM treaty. We are going through the ratification process at the moment, but hopefully early next year that will be done. And then the ESM will broaden its mandate and do a few more things. Importantly, providing the backstop to the SRF. So that is the next important step to complete banking union. We know there are more steps to follow, but this is the next one, and that can be done by the ESM. The other important parts of the revised ESM treaty is that we will strengthen our preventive and precautionary lending tools. And also we will have a new level of cooperation with the European Commission because the ESM will have a stronger role in designing, negotiating and monitoring future stability programs together with the Commission, of course. So that these are the important parts that are coming next year. Now you are asking what else could happen in a way. And before I talk about the very long-term question of integrating the ESM as an institution into the EU legal framework, because at the moment we are an intergovernmental institution based on international treaty, let me say that within the existing framework, based on the new ESM treaty, of course, the ESM also could provide other lending facilities. And that here I can pick up a point that was also mentioned by Hélène. I think the euro area needs a number of things. When we think about deepening EMU further, I think we need to complete the banking union. We need to make progress on capital markets union. All that would be important for more private risk sharing. And I think that's one of the important elements that we are missing. But also we need more public sector risk sharing. And that could be provided by a new additional ESM lending facility. Of course, we do have public risk sharing already today. We have it via the EU budget. We have it now with Next Generation EU. It also comes via EIB loans, for instance, in European Investment Bank, because those loans come with very low interest rates. It also happened when we did our lending during the Euro crisis, providing very cheap financing to 5 countries. But I think in the future, a fiscal stabilization facility is one of the elements that would strengthen monetary union, would provide more public risk sharing. There are several ideas how to do that. The IMF has talked about a rainy day fund. There's the idea of reinsuring national unemployment systems. But the ESM could also provide such a facility, which would be a revolving fund. And I would differentiate that very clearly from Next Generation EU, which, as also Paolo said, is not designed so much for stabilization. It has a little bit of that, but it's not really the DNA, as Paolo said. So that's all good. And we may need more of such EU financing for climate change, for digital transformation, to support structural reforms of all EU member states. But for the euro area, I think a macroeconomic stabilization facility that can give extra fiscal space to countries in the euro area, not outside the euro area, but in the euro area, countries that are hit by asymmetric shocks would be a very useful addition. Now, looking in the very long term, I'm in favor of integrating the ESM into the EU legal framework. But in my view, this should only happen if there is a change in the EU treaty, change of the primary law, because then we could follow the model that has existed for a long time, the European Investment Bank, that has its own capital. They are active in the market, issuing bonds. They have their own governing bodies where member states play an important role. But the EIB is part of the legal framework of the European Union. And that, I think, is a model that would fit very well also the ESM role and our work. But as I said, it requires a new treaty change. So this is not for the next 2 or 3 years, but more for the long term.
Thank you, Klaus. Let me now turn to Olli. Dear Olli, compared to the previous crisis, the resilience of the euro area in the pandemic has benefited from virtuous monetary fiscal interactions. At the same time, the recovery has been slower than in the US. What lessons can you draw from this experience and from the broader analysis conducted in the context of the ECB's strategy review? And how do you see monetary fiscal interactions going forward in view of the current outlook and balance of risks?
Thank you, Fabio. I will try to be rather brief, even though these issues are extremely important and broad. I just first want to comment what Klaus said when he was speaking about what the ECB is now and looks like being tomorrow. Quite a lot has happened in 1 decade. I recall the night between the 9th and 10th of May 2010 when the ESM or its precursor was created. So much evolution has been done over the past decade, and that's very much also thanks to Klaus and his very important work. Let me begin my answer concerning monetary fiscal interaction by saying that policy interaction or even coordination is by no means contradictory to central bank independence. I recall Tommaso Padoa-Schioppa once saying that independence should not be confused with isolation or loneliness. I very much agree with that philosophy. And in fact, that's also very much the gist of the ECB's strategy review, which examined monetary fiscal policy interactions in a period of low interest rates. We discussed that already in the first session. I would coin the prevailing view on this so that the paradigm has changed concerning the importance of monetary fiscal policy interaction that is recognized today. Meanwhile, the paradigm has not changed in a sense that debt sustainability still matters in the medium to long term. What does this imply for the current or future policy mix in the euro area? I think we have currently 3 main elements on the economic policy front. We have the national fiscal policy, we have EU-level fiscal policy supplementing it, and we have monetary policy, of course. So if you look at these in brief, so first, national fiscal policies have been very stimulative last year and this year, rightly so, and will remain so to a little less extent, as Paolo said, more moderately next year. Overall, we still need economic policy support in the euro area, but it should be more targeted and differentiated. And once there is stronger ground under our feet, then fiscal consolidation is much more convenient when government debt is inexpensive and growth is strong. So this is a window of opportunity for member states in this regard. Second, at the EU level, we have the Next Gen EU, which is providing significant flanking support to the national fiscal policies across the euro area in the coming years, especially 2022, 23, and 24. And it should enable a at some point a smooth transition from fiscal stimulus. Moreover, which I find quite important to recognize, is that the next Gen EU should, if properly implemented, help in enhancing the composition and quality of public finances by redirecting some spending from current expenditure to public and private investment, and thus supporting productivity growth and structural reforms. Third element is monetary policy, and here we are between the devil and the deep blue sea, between the higher than expected inflation in the short term and the worsening pandemic due to the new virus variant on the other hand. I do recognize that the micro experience of our citizens at the gas pump, fuel pump, is quite different from the macro reading of the economists and central bankers. Still, in our view, euro area inflation is mostly transitory due to the production bottlenecks and higher energy prices, even if some of its components will probably prevail longer over next year than previously expected. Of course, we will act when we see inflation reaching our 2% symmetric inflation target over the medium term in a durable and sustainable manner, meaning not just for a short period of time. But meanwhile, the ECB has pledged to maintain favorable financing conditions beyond the emergency phase of the pandemic and thus support price stability and growth. So to finalize, thus using a football analogy, I see the role of monetary policy within the broader policy framework of these three elements as being like a libero in the old school football teams like Franz Beckenbauer or Franco Baresi, who made sure that when the own team moves up the field to offense, this does not open up easy chances for the opposing team to counter-attack and score. In the youth teams, I used to play that position and I loved it, and I don't mind playing it again as a member of the ECB Governing Council. Thank you, Fabio.
Thank you very much, Olli. I totally agree with you. The current inflation spike is temporary and driven largely by supply factors, and central banks should have the patience to look through these effects and explain their policies to the people. Sorry for abusing my role, but I would now like to give the floor back to Hélène. Dear Hélène, NGEU was conceived as a temporary instrument. So what are the conditions for it to become a more permanent feature of the EU governance? There may also be interactions with fiscal governance at the national level. Could a central fiscal capacity go hand in hand with a strengthening of national fiscal frameworks, which in turn would allow for simpler rules at the EU level? And finally, major investments would be needed to reach environmental objectives. Do you see a scope for a green golden rule beyond what you have already mentioned, which would be widely accepted in the reform fiscal framework?
Thank you very much. All important questions also. So on next generation EU, and definitely the need for something like that going forward, I think is really important. I would also like to stress something that Klaus Regling said earlier, which is that also on the private sector side, we need more risk sharing. And so the capital market union, which has been in the cards for many, many years, should really move forward. I mean, I'm aware of all the legal problems there, etc. But this is also something that should facilitate all essentially the goals that we have been discussing here, whether we think about risk sharing or whether we think also about structural change in the economy. So I want to emphasize the private side as well. But from the official side, so yes, so what should we be looking for to make the next generation EU more of a permanent feature? I think there again, what is really key is the governance side, and really I want to emphasize the issue that we need to be very careful at evaluating and monitoring the implementation, and that goes from really watching for any issue on corruption to really being able to record results, identifiable, verifiable results of the program. So that's I would really stress governance here. In terms of whether this can go hand in hand with the national fiscal framework and the strengthening of the national fiscal frameworks. So I think indeed there is a need in several member states for strengthening of national fiscal framework. There is a need for much more, let's call that home ownership of fiscal rules. There are already, there's been several proposals which have come, and I think there's a relative consensus between the IMF, the European Fiscal Board, between, for example, the High Commission on Public Finances, of which I was a member for France as well, in terms of recommending transparent expenditure rules, multi-annual, so in particular that span, essentially the length of a government or multi-year, so that there is some flexibility, but also some visibility and some commitment on priorities at the beginning of a political mandate. I think these rules should be transparent, and that's what expenditure rules achieve, but also they should be much more discussed in Parliament. There should be enough time in various national parliaments to really discuss these rules. This is not always the case. So democratic scrutiny should be higher and should be informed by independent fiscal councils. And here again, if you look at the heterogeneity of the structure of fiscal council across member states, it's quite high in terms of what power they have, even sometimes the forecast horizons, what kind of prerogative, what kind of information they can have, what kind of information they can share, etc. And I think these things should be looked at much more carefully. So yes, all these can go hand in hand, and the strengthening of the national frameworks with a lot of ownership, national ownership and democratic ownership should be really high on the agenda. Besides that, for the European fiscal rules, so I think I did emphasize this in my kind of sustainability and growth pact with this idea of prudential fiscal governance. I do think that if we want to be prudent, there's a number of well-identified public investments, possibly with a ceiling, but well-identified public investments that have to be taken out of any type of deficit rule, so 3% rule or whatever rule. So we can call that the green golden rule or whatever. But I gave specific examples with pandemics, investment in global vaccination, and public investment aimed at transition towards net zero. These things can be quantified, are precise enough, and we should definitely take them out and think very carefully of this green golden rule, together with that prudential fiscal framework in which we think about all liabilities, not only the debt to GDP ratio the way we used to think about it, but really the liabilities that are with us because of climate change.
Thank you, Hélène. We have one question, but I will read it, but I think that Hélène has largely answered the question. I will read it on the idea of golden rules and raising investment. Do we include human capital investment as well as physical capital? Where do we draw the line? So unless one of the panelists wants to address rapidly this question, I would consider this has largely answered by the last comments by Hélène. Okay, so we have slightly exceeded our time, but not because we had a lousy chairman, but because we had a tremendously interesting and rich discussion. Let me thank all panelists for their interesting comments and contributions. I'm sure that today's discussion will stimulate further reflections among experts. There will now be a break until 4:30, when the conference will resume with a session chaired by Klaus. Thanks to all.